Hi everyone, it's Alex here at Session Capital Research. Welcome to our Tech Select Pro webinar, currently 19th of April at 5 p.m. East. Today, earnings season for tech has commenced in earnest. We're going to cover Tesla first of all. We're going to go on to Netflix, and we're going to look at the fundamentals, and we'll look at the stock reactions too. After that, we'll take a look at where the Nasdaq and I think the S&P as well stand, and look at possible directions tomorrow. On the assumption that Tesla continues down in the morning. We'll then move on to Q&A, and along the way we'll take in a few high beta, high growth software stocks that continue to hold up surprisingly well and continue to look bullish. So before then, we'll move on to our usual disclaimer, which we'll do right now. It's on your screen. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in this webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get going. Let's look at Tesla. So on your screen here, you have the fundamentals. We'll post this in a note later in the service, but just to walk everybody through it, let's just run through this quarter's numbers. So basically headlines were revenue of just over $23 billion, which shows continued slowing growth. So growth peaked for Tesla, at least on a trailing 12-month basis, in the March 22 quarter. It put in a 73% growth rate on a trailing 12-month basis, and that quarter was 81% versus the same quarter in the prior year. The quarter just reported, March 23, we now down to 24% growth versus the same quarter last year. And on a TTM basis, in other words, the last 4 quarters versus the prior year's 4 quarters, we're down to 38% now. Now, 38% still growing at a good clip for a business with $86 billion of trailing revenue, but the reduction in growth rate is what's driving the reduction in the share price principally. Gross margin, this is an important point for Tesla this quarter. So for the first time in a long time, gross margin dipped below 20%. You may recall that they have previously made a big deal about their automotive gross margins. They've broken it out as a separate segment, and they've always targeted above 20% automotive gross margins. The recent discounting and probably the inventory build have contributed to a reduction in gross margin. They do have other lines of business, but they're not sufficiently at scale to make a dent on any reductions in auto margins. And so we now have group gross margins at sub 20%. I think I'm right in saying that they haven't broken out automotive gross margin this quarter. And if that's correct, then that's something of a red flag. Trailing 12-month gross margin now to 23% from a peak of 27 as recently as September 27. So sorry, September 22. So that margin profile is coming down hard, and no surprise, if you discount, then that's just what happens. Operating income, $2.6 billion, and if you scale back to EBITDA, our normal measure, then you get to a trailing 12-month EBITDA margin now of 21% versus a peak of 24%, again as recently as September 22. So one, margins are coming down, and two, they're coming down quickly. Trailing 12-month margins don't move quickly. They're flywheel measures. They are slow to spin up and they're slow to spin down. And so if they drop 3 points over the course of 2 quarters, that's a lot. Cash flow dropped even harder. So pre-tax free cash flow in the quarter was just over $500 million. It's been as high as $3.4 billion in the September 22 quarter, and smoothing out the differences, peak cash flow margins on a TTM basis, 13% in September 22, now halved, 7% in March 23. So again, you have margins coming down, but you have them coming down fast, really fast. For trailing 12-month cash flow margins to halve in the space of 2 quarters, that's really tough. Balance sheet remains incredibly strong, so you have $20 billion of net cash. There's no stress on the balance sheet whatsoever. Deferred revenue is limited at Tesla. So overall, that's a pretty weak quarter, and the direction of travel remains unchanged, which is to say slowing growth and margins coming down fairly dramatically. So there's not really any fundamental reason for the stock to hold up in the near term. Stock reaction so far, to be honest, has been, I would say, not that bad. So if we look at this is a daily chart for Tesla here. So we're currently down just over 5 points on the day, which is only a little bit down in post-market hours. And as you can see, the stock it's up off its lows a bit for the day. It's not a good look though, and so at a minimum, I think we would expect the stock to come off some more. What you're seeing here is a daily chart since the stock struck the lows at the end of December. So if you remember, it was down to nearly 100 back then. So if we just chart this out properly, so the low was January the 5th, but it was just over $100 a share. It moved up to a Q1 high in February the 15th of $218 a share, so pretty dramatic recovery. And we're going to call that a wave one up. It's an unbroken wave one up. You can see there's no real sell-off at any point between January and February. The month was straight up. Where it does start to turn is left at the February high. And in the wave system we use, what you very often see in a sell-off is an A down, B up, C down pattern, where basically you get an initial sell-off, a counter trend reversal to the upside, a fake out if you like, where you believe that everyone believes that all is going to be fine, but oops, then it turns on you and goes down once again. So best guess, we're going to get a continuation of this C leg down. And where could that stop? Well, very often you see the C leg equal to the A leg in terms of the share price move. And so this A leg you see here dropped, let me see, from about 218 to about 164. So let's call that $50 odd a share. And this B wave peaked here at 207. So we might see some downside to around, 155-ish, thereabouts. We could, though, go a lot lower. And so even if you are bullish Tesla for the long term, there's no reason why after this big wave one up here, dramatic wave one up here, you couldn't see a 78.6 retrace of that wave one. Even if you're bullish, that would not invalidate any long-term bullish argument on Tesla. But if it does, that means we're heading down to, the 120s maybe. And that sounds silly now, but it's not silly. It's just a normal retracement for such a dramatic move up. So the key with Tesla, and for disclosure, I'm short Tesla. I have been long in the past. I may well be long in the future, but for now I'm short Tesla via long-dated puts. The key with Tesla is just watch the price action. The fundamentals are not good. So I don't think you can point to the fundamentals and say, well, once people realize, they'll get excited about the stock again. There needs to be some other narrative that drives the stock up. And if you have to ask yourself, what could that narrative be? It could be federal tax credits. So the new incoming federal tax credit regime gives far more benefit to Tesla and other US manufacturers than it does to Volkswagen, Mercedes-Benz, and other overseas manufacturers. That's obviously by design, and that will help Tesla. Most people would take the view that technically Tesla vehicles are falling behind somewhat. They've underinvested in new product development. Most people take the view that VW, Mercedes, EVs are improving dramatically, and so probably they have product development momentum edge on Tesla these days. But the absence of full tax credits will make a big difference to the selling price in the US market, which is the biggest market for EVs. So you have a possible tailwind from the new tax credit regime. So far, betting against Musk has been a bad idea, and so usually there is a rabbit pulled from the hat at some point. So in seeing some downside for Tesla stock here, I don't wish to sound religious on the subject. I just think the company's having a bad time, the stock looks under pressure, and we may see some more downside. That isn't to say that the stock can't recover. In particular, if we're to look at we zoom out a little bit, and if we look at the weekly pattern, then let's see where we stand. Because this is what the stock has done since the 2019 lows. It put in a clean, technically clean 1, 2, 3, 4, 5 waves up, peaking at the end of October 21. And it then sold off to a picture perfect 78.6 Fibonacci retrace from that wave 1 high, and then bounced that huge January to February bounce that you see here. So this chart, on this larger degree, this is a bullish looking chart. All you have here is a wave 1 up and the beginnings of a wave 2 down. And so I don't think one can conclude either from the numbers or the history of the management team or the technicals that it's all over for Tesla, as many religious, anti-Tesla religious folks would like to say. Equally, I don't think you can say that suddenly the company is going to put in a dramatic performance tomorrow. There's no evidence for that. So I think we just have to watch the price. Personally, my intention is to stay short for now. I suspect there's more downside. I would hope to be able to cash in that short at a reasonable profit and then wait to see what happens, particularly if it approaches, let's switch back onto the daily for the moment, particularly if it approaches this 125 level, 126 level, which is a 78.6 retrace of that Q1 wave 1 up, then it would be a surprise to not see some sort of bounce at that level. So let's see. Now, we've got Netflix to do, but it might be a good idea to do some Q&A right now, as many people follow Tesla, of course. So I'm going to unmute everybody. And if you have any questions, points, anything at all to raise on Tesla specifically, now's a great time. So just unmute yourself your side and shout into the system if you can. If not, then you can use the question function or indeed the chat function in the website, in the webinar platform here. But audio is much better. So any points at all to raise on Tesla, now's a great time. Ron, you have your hand up. I'm going to unmute you. Okay, you're on.
Okay, thanks, Alex. I just wanted to make the comment from what I've read. My perception is that Elon Musk is going for the most affordable electric vehicle, and he showed that recently by the price cuts, and he was making his, the Tesla more affordable than anything else out on the market, as far as I know. And they do have I think they announced that they do have a new model coming out that I think they said it would be a $30,000 electric vehicle. So I'm just making the comment that, if you want to be able to have the least expensive, reliable, proven electric vehicle out there, yeah, your margins are going to go low. And but if they come out with this new model that is the least expensive, because VW, their car, and Mercedes-Benz, you can just imagine the cost. They're probably going to be $60,000, $70,000, $80,000 electric vehicles. That's all I had to say.
Yeah, no, I think it's a good argument, and I think the company would argue something along the following lines, as you just laid out, which is, look, we're going to go for volume. We're the only profitable and cash generative pure play EV maker out there. We have this is the argument I would make if I was on their side, right? We have a $20 billion cash pile, no debt or no meaningful debt to speak of, and we have we're the undisputed leader in volume production of EVs. So it's all very interesting that Daimler-Benz and Volkswagen and all these guys have come along, and they're subsidizing their EV production with their dying ICE models, which, by the way, ICEs are going to be outlawed before too long. And by the way, their EVs are negative gross margin vehicles, and so that's all very interesting. But we're the volume leader. We're the only pure play profitable leader. We have a huge cash pile, a huge technology advantage. We have supportive federal tax environment, And this is just a question of adjusting from a more of a high-end positioning where we once occupied. We've always said we were going to be the lowest cost operator, and we're just transitioning to that environment. So that would be the argument I'd make if I was at the company, and it might even be true. All you can say is in the near term, margin pressure as well as growth pressure isn't a great look. If the company was showing accelerating revenue growth and margins coming down in order to fuel that revenue growth, every growth investor would understand that and would probably buy it, to be honest. So if what you saw is the cash flow margins coming down, even going negative, but growth ticking up, I think that then the numbers would fit the narrative, and we may yet get there. So it might be that in a couple of quarters' time, that's the truth, but it's not the truth yet. And so I think the key with Tesla for me is just treat it like a business, like a stock. There's nothing special about it. It isn't. I mean, it is a cult, but you don't need to buy into the cult to make money from the stock. You just look at the stock's technical behavior, look at the company fundamentals, and make your decision. And so for me, there's probably more downside right now, but I also think if we do drop to that, I mean, if we drop anywhere near that 125 level, then just technically you ought to see a pretty dramatic reversal. And actually, if you even got down to 160, 145, which are the two Fibonacci layers above that, again, just technically you ought to see a reversal. So I think the thing with Tesla is keep a calm head and just, if you're going to play the hand that's actually there, not the hand that the various Musk apparatchiks would tell you is the case on Twitter, because they should just be ignored. What should be looked at is the numbers and the stock price behavior.
Yep, perfect.
Yeah.
Thank you.
That's all I got. Welcome. Thank you, Ron. Anyone else, folks? Mayank, you have a question? Let me see. Okay.
Yes, that's right. I've got a question. So Tesla just reduced the prices yesterday, one day before results. Now, I don't understand what's the reasoning behind that, but
Me neither, to be honest.
Yeah,
I mean, I thought it was really strange because obviously anything they do yesterday isn't going to show up in their earnings. So I thought it was really strange.
yeah. But
is it a red flag? Honestly, I don't know. I mean, it's the trouble is so many things that Musk does are just for the theater. And you can imagine him doing that just to say, well, look, we're reducing prices. We're going for the volume argument. So even yesterday, we reduced prices. So I imagine there'll be some. I don't bother listening to Tesla earnings calls, to be honest, because there's no point. I feel that way about most companies, which is, why am I spending an hour getting lied to when I could just look at the numbers and the charts? And I don't mean just Tesla. I mean almost every company we cover. And so there'll probably be some commentary about it on the earnings call. But I agree. I don't know why you would do it. It seems like it's just a distraction or something. I don't know.
Yeah, absolutely. Because I love Tesla as a company, but the way I think is I detach the stock price from the company itself or the cult itself, and as you said, look at the fundamentals, look at the numbers. So to me, it's like just one day before you're getting your results out, you reduce prices. So what's the reasoning or the logic? And nothing was mentioned. So I just thought I'll ask you if you had been better inside.
I agree. And look, I mean, I've been very bullish on Tesla in the past. I mean, until very recently, the fundamentals were fantastic, high growth, high margin, what's not to like, right? So I think the falling into this, cult member or anti-cult member is a great way to lose money, and just keeping really clear-eyed on what the company is actually achieving and not achieving. It's a highly volatile stock. That's always a great place to be. If you want to make money from stocks, you want volatility. And you just got to look at the fundamentals. It's also true that if you look at the product positioning, I think Tesla products now are long in the tooth. I mean, I remember driving around in one in 2012, a Model S, thinking this thing's incredible. The Model S now is not that dissimilar to what it was in 2012, and I don't own one because they don't make any vehicles that I can fit my two dogs in. But I've tried Model 3s and Model Ys and things, and they are, old. That said, although I think that if you were to drive a modern Audi or VW or Mercedes, they're pretty good, the electrics, but of course they don't announce the unit economics of their EVs. It's all blended in. And so I would imagine that they are heavily subsidized vehicles where, of course, they're good cars for the price because they're losing money on every single one. Whereas today, Tesla's made money on every single one. So I suspect that you are comparing, an older product line that's very cash generative with a highly subsidized set of new product lines that don't have federal tax credit support, and that the big traditional auto manufacturers still have their day of reckoning, because in Europe before the US, ICE models are going to get cracked down on really hard, and so all those legacy makers are going to have to transition to EVs faster than they were expecting, and I don't think they have the unit economics to do that, and I think Tesla does. So I think there is every possibility that the at scale, at lower cost argument might win out. But my personal opinion is I wish that Musk would just hire a Gwynne Shotwell type. So Gwynne Shotwell, who's chief exec at SpaceX, and just quietly gets on with running, a really effective business with operational excellence. And I wish that he would hire that kind of CEO at Tesla, because that seems to be what the company's crying out for. It needs less hoopla, more operating efficiency, less marketing, and more execution. And so I think that, and he must know that, he's a long way from being a fool. And so I think that if truly they can grasp the volume opportunity and they appoint a CEO or a COO to do that, that's the time to get excited about the stock again, when they can show growth is accelerating, even at the expense of margins. I think that's fine. And as the regulatory pressure on the legacy vendors steps up, as they have to, wind down their IC fuel models, that's probably a time when Tesla can reassert its advantage. But right now, I think it's got some troubles.
Agreed. Thank you.
You're welcome. Anybody else, folks? Okay, let's move on. Let's do Netflix. So Netflix reported yesterday after the bell. Let's get, again, fundamentals up here. So Netflix, everyone was squealing on the print saying it's, dreadful numbers and the rest of it, but I personally thought they were all right. And the two numbers that shone out were as follows. So the company delivered $8.2 billion of revenue in the quarter, which was 4% up on the same quarter last year. Now, why that's important is because across our business at Cestrian, we cover 50, 60 growth companies. And for the last 12, 18 months, most of them have been decelerating earnings growth. They're almost all still growing, with the exception of NVIDIA, but the rate of growth has been coming down. And I think only Netflix and maybe one or two others has shown any acceleration in revenue growth. And so if you look at this top colored line here, the way we do these spreadsheets is yellow means, getting worse, and green means getting better. And look, this is the first green dot on the revenue growth line for Netflix in a very long time. And if I look at across our growth stock coverage, there aren't many green boxes on that revenue growth line at the moment. Most people are slowing. So the fact that it accelerated, albeit only to 4%, but an acceleration is an acceleration. And with a subscription like business like Netflix, again, you have a flywheel effect in the revenue. It's slow to spin up, it's slow to spin down. And so that looked good to me. It's still slowing on a trailing 12-month basis, but again, that's that flywheel effect. But the fact is that first quarterly tick up is important. And the other thing is if you cut all the way through to cash flow margins, and they're a bit fiddly to work out at Netflix, I'll explain that in a minute, then we've got cash flow margins that have just gone up stepwise for 1, 2, 3, 4, 5 quarters now. And that's a trailing 12-month measure. So again, slow to spin up, slow to spin down. So the fact that they're up so much so quickly is really testament to the team doing a really good job. We don't measure EBITDA at Netflix, because by the time you add back content amortization, you end up with a number that's preposterously huge and meaningless. So we go straight to cash flow, and the way we do that is we take the operating income, add back depreciation. So that's a depreciation of hard assets like computers, tables, any offices they might own, that sort of thing. There's a whole bunch of other non-cash items, which is to do with content amortization. There's a little bit of stock-based comp, there's a little bit of capex, and there's a little bit of change in net working capital. But the big movements here are money that's laid out for content and the amortization of the content purchases. So you get back to a free cash flow margin of about 14% on a trailing 12-month basis at 4% growth. And again, you've got growth turning up and margins turning up. So I thought they looked pretty good personally. Look at the balance sheet, they carry a net debt load. But if you look at the leverage, and here, normally with leverage, you measure it as a multiple of trailing 12-month EBITDA. Here, EBITDA at Netflix doesn't make any sense because of the heavy content acquisition costs that come after EBITDA is measured. So for Netflix, we look at leverage as a multiple of trailing 12-month cash flow. It was as high as 8 times trailing 12-month cash flow in December 21. It's now down to 1.5. So the company's delevered really quickly. Cash flow margins are coming up quickly, and growth just turned up. So I looked at it last night, and I must admit, I thought that looks pretty good. Now the stock reaction, initially it dropped 9% in post-market yesterday. It came back up to flat, down a bit today, I think. But overall, I think that's not a bad performance at all from Netflix. If we look at the stock chart just now, yeah, it's down a few points today. Okay, so let's just look at where the stock has come from. So this is a daily chart. Well, first of all, let's take the long-term chart. It's pretty interesting to look at. This is a monthly chart. Now, I'm old, so I remember Netflix of old. And it's gone through a number of incarnations where it looked like the company was finished and they managed to reinvent themselves very successfully. This chart here is a monthly chart, and it goes from the 2012 lows. And Netflix moves up from around $5 in 2012. This is, did they do a split? Yeah, this is split adjusted, up to $700 at the end of October 21. So an incredible run up. And then it drops again to our old friend, the 78.6 Fibonacci retracement, almost to the dollar. So it troughs out at $163, and the 78.6 retrace will be 154. So, a really nice tight Fibonacci retrace there. And then, and this is again at the May period last year. Now, May in 22 was a key point where many of these high growth stocks bounced and reversed upwards. Everyone thinks that it was a bear market all year, but it wasn't. The companies that sold off hardest mostly found support in the April, May, June timeframe. Netflix moved up really strongly, and a bit like Tesla did from January to February, you've got just an unbroken move up here. You're just seeing that excess being shed off a bit now. So if we go back to the daily chart right here, this is the moves that it's put in since those since the lows. Okay, so here's the low. This is June. It put in a double bottom. There's a bottom in May there, around 162. Double bottoms in June, and this is the moves it puts in. A wave one up to about 255 in August. Sells back down again. Wave two low. A 0.5 retrace. Quite a shallow wave two that, but a 0.5 retrace in October 22. Big then move up. Wave three peaks somewhere between the 1.618 and the 2.236 Fibonacci extension of wave one. So that's a solid wave three. Anything around the 1.618 extension you can say is high confidence wave three. We then get a wave four sell-off. Again, a fairly shallow wave four. It could have gone down as deep as 259 and it wouldn't have been invalidated for the pattern, but actually it hits bottom at 285, which is around a 0.5 retrace. And then it looks like we're in the early stages now of a wave 5 up on this scale. Wave 5s very often will terminate between the 0.618 to the 0.786 extension of waves 1 to 3 combined. So Netflix to me looks like it could keep moving up, and it could top out in the 420s, let's say. Some weakness initially here, but again, let's just, if we try and run, I'm going to break this down into a 4-hour chart, and if we were to look at the move up from March, then what you see here is 2, 3, 4. We're just in a wave 4 down here, and so in fact, if you look, oh, that's amazing. Okay, aside from the brief after-hour sell-off yesterday, then in real-time trading hours today, Netflix troughed at exactly that wave 1 high. So I think Netflix can move back up again. I think that people underestimate how good a set of financials that is. Growth accelerating, margins ticking up, leverage down to 1.5 times versus 8 times just over a year ago. So I think that's a pretty good outcome, and I think this thing can move up. And for disclosure, I'm long Netflix, so that's where my prejudice lies. But I think this thing can surprise to the upside. It's also, you know, a bit like Tesla. It's the only pure play streamer. It's the only profitable and cash generative streamer. And so, you know, whatever problems they may have, they do have a nice cash generative model. They don't have a balance sheet that looks like Tesla's. It's in a net debt, not net cash position, but it's still a strong balance sheet. They have plenty of money to spend on content. And so I think personally the future is probably pretty bright for Netflix. Okay, any questions on that one, folks, before we move on to the NASDAQ or any of the scary high beta stuff? Okay, let's do the NASDAQ next. So for those of you who are members of our Market Insight Substack, you'll get these charts every day if you're a premium or a pro member. If you're not a member of that service yet, you should join it. It's great. It's not expensive, and it gives you actionable long-term and short-term levels in all of the 4 indices every single day. After this session, I'll post a link to the service just in case anyone wants to join. But let's have a look at how the indices are doing. So let's switch back to a weekly chart. And let's look at the NASDAQ. NASDAQ looking solidly bullish over the medium term. And so let's just take a look at where this stands. So this is from the 2018 lows, the last time that monetary policy was reversed. So through 2018, you saw tightening from the Federal Reserve. At the end of 2018, that ended fairly abruptly, and you went into a loosening regime. So this wave 1 up in the NASDAQ is a monetary policy function. It's not really earnings or anything else. It's just more money being flooded into the system by the Fed at lower cost. COVID comes along, you get a wave 2 sell-off down to our old friend, the 78.6 retrace. Federal money rushes in, wave 3 up, peaking at the 2.618 extension of wave 1 for a strong, solid wave 3. Wave 4 sell down, puts in a 1, 2, 3, 4, 5 quadruple bottom at the 61.8 retrace of that wave 3 up, which is around 258, and since then it started this climb up to what we think will be all-time highs. Now, this medium to long term, so looking at a year or so, we're very bullish on the NASDAQ. Short term, though, it's quite a different story, and you can see that it's run up just very, very strongly in recent months. And let's zoom in and look at this in a bit more detail. So I'm going to switch this on to a 2-hour chart. Again, if you get our Market Insight, our Substack, you'll have seen these every day anyway, but let's just run through this. So this is the most recent move up of the NASDAQ. This is since January the 6th. I'm using the futures charts here because it just gives more trading data, but the dimensions of the moves, the percentage changes are the same for the index and for the ETF, more or less anyway. So we get from the lows here in January, we get wave 1 up, 2 down, 3 up, big wave 3 up between the 2.618 and the 3.236 extension of that wave 1. So that's a big aggressive wave 3 up. We get a wave 4 down that retraces to the 61.8 retrace of this wave 3, and we then move into this wave 5 up. Now, you heard me say earlier that wave 5s very often terminate between the 61.8 and the 78.6 extension of waves 1 to 3 combined, and that looks like it's been the case here. You know, again, almost to the dollar. Scary sometimes how well these fib and wave charts work. So back in the 4th of April, we get what looks like a wave 5 high right there at 13,340 on the futures, and on the QQQ it was around 322. And since then it's sort of meandered but trended down a bit. And so our expectation is that the Nasdaq is going to see a short-term sell-off. What caused that? Well, it's probably not going to be Federal Reserve liquidity. You know, we might see another rate hike, maybe, I don't know. But more likely, I think it's going to be weak earnings from big tech, because, you know, Tesla, I think, is a forerunner of things to come. I don't expect wonderful things from Apple or Microsoft or Intel or any of these companies, really. Q4 was pretty dreadful for all of them. There's no particular reason why Q1 should be any different. In Q4, the market was all beaten up. And so when they printed, you know, even fairly bad Q4 numbers, market was so depressed that, number one, you had a whole wall of puts that expired out of the money, leading to dealer rebalancing, leading to a short covering rally. And two, everyone was so depressed. The fact that the company hadn't basically gone bankrupt meant everyone started buying stocks again, which is nuts, but, you know, there you go. Here, Nasdaq's had a big run up, and so I think if we get weak earnings, we're going to get a sell-off. So my best guess for the Nasdaq is we're going to see some downside. Again, even if you're a Nasdaq bull, and I am, we could see the Nasdaq sell off down to the 78.6 retrace of this move up from early January. So on the futures, we could go as low as 11,300. If we were to look on the ETFs, then this is the QQQ ETF, and, you know, we could go as low as 270, and that still would be a bullish long-term pattern. So if you see Nasdaq sell off, you know, don't freak out if you have a longer term time frame than a few weeks, because, you know, moves up do tend to shed excess and sell down again before they move up again. So we think Nasdaq will sell down. We personally, my personal account, I'm hedged in Nasdaq, have a long position using the TQQQ ETF and a short position using the SQQQ ETF. So right now I'm absolutely 1-for-1 hedged. So if it goes up or goes down, it makes no net difference to my net account balance. What I hope to do is, if it does in fact sell off, I hope to be able to cash in that short leg at some point to bank gains, and then ride the long leg back up. And we'll see if that's successful or not, but that's been working pretty well for me personally over the course of the last 9 months or so. That sort of go. And we trade this live in our real-time service, by the way. So that's the Nasdaq, which is to say bullish medium term, quite concerned short term, just because of, you know, the degree of that run up has been so strong, and I don't think that big tech earnings are going to do much to excite anybody to move the stock up further. Would be my take anyway. I want to just look at the S&P as well. S&P is a slightly different story. You know, they often move at the same rates, but what's happened to the S&P really is that it's gone sideways since March last year. No one thinks that. Everyone thinks 22 was dreadful. We've had this V-shaped recovery, but it's just gone sideways. So you had a couple of brief low volume forays into these low levels down here, but really it's just gone sideways. And if I were to speculate, I would say that this is institutional accumulation in readiness for the next move up, and the move up being in a higher rate, higher inflation environment that spooks out retail, but, you know, no reason that should spook out institutions. So I would see this as accumulation sideways action due to move up. Now you can see here that the S&P, this is the SPY ETF, is approaching the top of this accumulation box, and so we may see some short-term sell-off in the S&P, but I would not view that as invalidating an overall bullish thesis over the medium term. If we were to look at the futures, actually the interesting thing with the futures is that they just hit a triple top since the December high. So this is the ES mini contract. It's an artificial contract. This is the it's a so-called continuous contract that's used for charting purposes. But you can see that we reached a high of 4,200 in December, again in February, and we just failed to touch it yesterday. So I think that this triple top is proving pretty solid resistance. At some point, it will break through and turn that into support, but probably not yet. So I think there's probably a little bit of downside in the S&P. For disclosure, I have a small short position in the S&P using the SPX, SPXU ETF. Again, medium to longer term, I'm bullish on the index, and so I hold the short purely to try to get some advantage from any sell-off, which point I hope to cash it in and then ride the long side back up again. So that's the S&P. Okay, I want to move on in a minute to talk about some high growth stocks. But before we do that, any questions at all on the NASDAQ or the S&P, or indeed anything else we talked about so far? If so, just unmute yourself and shout. Okay, nothing. Let's move on. So I want to just pick out 2 or 3 of the high beta software stocks that we cover and show you how strong they're looking. So this is Cloudflare, ticker NET. So this is another stock that's been under accumulation since May last year. This accumulation box is quite wide, so it troughed at, let me see, 37, top of the box is around 65, so that's obviously a big range. But the point is, it's just gone sideways for nearly a year now. At some point, we think this is going to break out. The company's fundamentals are improving considerably. It's taking share in the security market quite nicely. The company is marketing itself like there's no tomorrow, marketing the stock as well in that way. And so I think that Cloudflare can break out fairly soon. Best guess, if Tesla takes the NASDAQ and the S&P down a bit the next 2 days, we'll probably see some weakness in Cloudflare, but thereafter I think it can really move up. If we were to look at MongoDB, which is a database software vendor, this is already moved up into what we call the markup zone, where we think basically this is late money coming in now, bidding this thing up. So we'd held this at accumulate all the way from that 78.6 retrace of the prior wave one up, which is $127, up to the top of this high volume node here, where it looks like institutional buying has started to peter out. So we'd said that up to around 208, it was a good buy. In fact, you could argue, to be honest, that even at 226, it's not a bad buy, except that probably will sell off a little bit first before moving up again. But MongoDB, I think, can make new highs. Company's growth rate is strong. It's becoming cash flow positive on a continuous basis. It's put some cash flow positive quarters in, but hasn't achieved that continuously. It looks like it's going to do that soon. Enterprise acceptance of the product set is increasing, such that the product, I think, can become used not just by high volume e-commerce players, but also by sleepy old enterprises. And that's where the real money starts. And then lastly, let's look at the poster child here, which is the ARK Innovation ETF. Now again, crazy up, crazy down. What we do here is a chart method that's slightly artificial, but we imagine that the stock once traded at notional zero value, and we run the chart from zero to the all-time high and retrace it back again. What you very often see with these high beta names is you get a retrace back to the 78.6% reversal from zero to that all-time high, and that's the case with the ARK ETF as well here. Now again, it's been under accumulation since May last year. Look at the volume here on the volume by price indicators. Huge volume down here. That's not retail, that's institutional. And so we expect ARK to break out again quite soon. Now, if Tesla makes a mess of the NASDAQ, then it's unlikely that ARK breaks out tomorrow. You probably get some time to pick stock up there if you're interested. But we do think these high growth names are going to take people by surprise to the upside. Most of them are maintaining much higher levels of growth than our big tech. They're all slowing a bit, but they're not crawling. And most of them are also seeing growing cash flow margins as well. So the fundamental story at most of these high growth names is good, better than at your big tech companies. The stocks are, incredibly beaten up still. So the potential for them to snap back to the upside is pretty high, I would say. For disclosure, I'm long Cloudflare, and I don't own any ARK ARKK, but I am long ARKW, which is the next generation internet ETF that ARK Invest manages. Okay, anything on those folks or anything at all that we've covered today? Now is a great time to ask. So everybody's unmuted. Mayank, go for it.
Any view on GitLab? Looking at the chart at the moment.
GitLab, yeah.
I think it.
Yeah, we cover it. Hold on a second. Haven't looked at it in a little while. Yeah, ouch. Okay, let's switch on to daily. Here we go. Okay, so we have this accumulate rating. Yeah, so this is another one where, let's go for a weekly chart. Hold on. Bear with me 1 second. Okay, so the stock IPOs comes out hot out of the gate, promptly dives. And again, with the chart method we've used here is we've said start from a notional 0, track it up to the all-time high up here. Gosh, no, even higher up here. So it peaked at 136, I think, and then track the sell-off. And again, it's touched this 78.6 retrace of that move up, and it touched that in March last year, thought about it in May last year, again in November last year, and now in March this year. So it looks to me like that's pretty good, solid fundamental support, that level. So let's call it around $30 a share-ish. Volume looks pretty high at that level. And so I think this is GitLab is a company, we rate it accumulate. I own it personally, I'm long the stock. And I think it might take a while to break out, but I do think it'll break out. Also, wouldn't surprise me to see it get acquired. I think there's been some buying by Google, if I recall correctly, recently. And it's a well-liked tool, GitLab, by its users, extensively used, extensively liked by engineer users. So yeah, I think it's easy to get bullish on this one, although it might take a while. That would be my view.
Okay, thank you.
Welcome. Anyone else, folks? Ron, I'm going to unmute you. Okay, you're on.
Yeah, Alex, do you mind if I just kind of pick your brain on the Cloudflare?
Go for it.
I'm looking at the chart now, and I agree with you that it since April or March of 2022, it's been pretty flat. But if you look at it just in the past 6 months, from January to the present, in January it was about, say, 44, 46, and now it's 60, 62, 63 range. So right. Effectively, it's gone up 50% since January.
Yeah, it has. So if we zoom in, there's a daily chart in front of you now. So this is the lows, early January, troughs out at around 37, 38, puts in a big move up to 73, and then wave 2 down to 61.8 retrace down to 51. Let's move back up again. So yeah, I mean, the reason that these stocks, by the way, I think at least I think the reason they're doing this long drawn out accumulation is because Cloudflare, MongoDB, GitLab, all these names, these are the fundamental pillars of the enterprise software stack for tomorrow. So if you're an institution, you need to own these companies, because in 5 and 10 years time, the stock prices then are going to bear no relation to the stock price now. So you need to start getting in now. The problem with them is they're relatively small caps, and there's not much liquidity because of that. So if you're, Fidelity or a big insurance company or whoever you might be, and you want to build a stake in what are today relatively small companies, it takes time. You can't buy enough stock quickly enough without moving the stock, and so therefore you get these long drawn out accumulation periods. And frankly, if you're trading the stocks, then even within that accumulation zone, as you pointed out, you can make 50% to the upside, another 20% to the downside, rinse and repeat. Institutions will be doing a bit of that, but to build a long-term position for their long-term accounts, it just takes some time, and that's why you see these long drawn-out accumulation periods, where for a more liquid stock, a Microsoft or an Intel, whatever it might be, there's more traded stock, you can get it done more quickly. But this long drawn-out, sideways range-bound action, this looks a lot like accumulation, and you can't say this for every company out there, but Cloudflare, MongoDB, GitLab, who else? Datadog, Dynatrace. These companies. This is the legacy software stack of tomorrow. When they've gone X growth and they're hugely cash flow generative. So you want to be buying into these things now, and I think that's why you're seeing this big sideways action. When this breaks out, and I do expect it to break out, I think this can move very dramatically to the upside, because you'll see a whole lot of short covering, momentum chasing, retail getting all excited again, and I think it can be a big move up when it breaks, but it hasn't broken yet, and that we may yet see another sell-off down back into this accumulation zone before a final breakout.
Okay, so do you think we're in a wave 3 up now?
Looks like it, doesn't it? So if you look at look at the daily, yeah, it looks like it, doesn't it? Yeah.
So what's the possible wave 3 up range? Okay, just using the chart in the Fibonacci extension.
So just your standard extensions here would be, so the wave 2 troughed at almost exactly the 61.8 retrace. So I personally, I much prefer wave 2s at the 78.6. So that gives me a really high confidence that that's it, it's done selling, right? But technically you can say if it's between the 61.8 and the 78.6, then that's a wave 2 down. So you wave 2 low there. So I'd say, yeah, we're in a wave 3 now. Wave 3s, for non-volatile stocks. So for example, if you look at the Dow, when it puts in a wave 3, tends to top out at either the 100% or the 1.236 extension of the prior wave 1. These higher growth stocks, if you're being cautious, you would say, well, the minimum target is 74, which would be just above the wave 1 high. A target of it really should get there is 86, which is the 100% extension of that wave 1. But really, we shouldn't be surprised to see Cloudflare at 108, within a number of months, because it's only the 1.618 extension of that wave 1, and this is a high growth, potentially explosive stock. So I would say that anyone trading the wave 3 move, it's not silly to expect it to reach 108. I mean, it could reach more, but 108 is, people will tell you that 1.618 extension, that's about what you should expect for a stock like this. And so the profit potential from here, even trading short term, remains pretty big. I mean, that's more than the 50% move. If we do get up there, again, we can expect a wave 4 sell-off down, but these wave 3s, they often surprise to the upside, and I suspect Cloudflare will do that.
Fantastic. Thank you, Alex.
Welcome. Anyone else, folks? Got a few minutes left. Okay, well, I'm just going to mute you again. Ron, 1 second. Okay, well, we're done for today. So we're into tech earnings season proper now. We'll see what happens to Tesla. So let's check on the current price. Okay, so it's down 6 points. Okay, so let's see what happens tomorrow. Tesla down hard tomorrow could drag the Nasdaq and the S&P down a little bit. It's unlikely to destroy it, but it can start to drag it down. And if we see weak earnings from Microsoft and Google and Apple and so forth, then expect to see something of a sell-off in the Nasdaq the way that we just laid out. Overall, though, remain bullish for 2023 overall, and we fully expect these indices to be making new highs and dragging up these stocks with them, even if we see some short-term weakness around this earnings. So it remains to me to say thank you everyone for being a member of this service, going from strength to strength. We're growing every week, which is fantastic. We had a really strong 2022, which is terrific given the environment, and 2023 even better. So thanks everyone for being a member here. I'll circulate details later on of that market insight Substack that you may want to take a look at. And I'm also going to include a note on our newest and best service that you may wish to consider. It's called Inner Circle. It's our very best quality work. Slow burn, thoughtful. It's the depth and breadth of work that we use to invest our own money here at Cestrian, and so it's something you might want to consider. And I'll circulate details of that as well. Thanks everyone. Look forward to speaking to you soon.